In this video, we are going to be talking about the 5 key areas within the investment banking division: M&A, leverage finance, equity capital markets, debt capital markets, and restructuring. Whew. What is going on YouTube? Welcome back to the channel. For those of you that are new here, my name is Afsar Hussain. You can find out a bit more about me through the social media links below, or you can check out my website, which is www.afsarhussain.com. In today's video, we are going to be talking about what exactly is the investment banking division, what do they do, what are the different subsectors or sub areas within the investment banking division. So let's get straight into it. There are 5 key areas within the investment banking division, first of which is mergers and acquisitions. Then there is equity capital markets, then there is debt capital markets, leverage finance, and restructuring. There are lots of other subcategories, let's call them, but those are the 5 key areas. And when you're applying or when you're going to be interning, you're likely going to be in one of those areas. In this video, I want to give you a high-level overview of what these areas are. Very important for you to know if you're interested in investment banking, specifically within an investment bank, which typically, or global investment bank, which typically has lots of different divisions: asset management, sales and trading, operations, risk, investment banking division being one of those. Okay, first off, let's start with mergers and acquisitions, otherwise known as M&A. Mergers are simply when 2 companies decide to combine in order to form a larger corporation for purposes that might be revenue driven, growth driven. They might see common synergies, or they might be very similar, and so it makes sense to just combine and merge and become one unit. Oftentimes when 2 companies or 1 company is failing, they might merge with another company. This happened a lot in the financial crisis. So Bank of America and Merrill Lynch merged into Bank of America and Merrill Lynch. Lots of companies merge for various reasons. So that's what mergers are, when 2 companies merge and become one. And then there are acquisitions. An acquisition is simply when a larger company takes over a smaller company. So for example, Facebook acquired Instagram. It was interested in that business. It was interested in seeing how it can run that corporation, how it can make it more revenue generating, more efficient, more effective, how it fits into Facebook as a global organization. So acquisitions are basically when a company is interested in a smaller company and thinks it can do a better job at running that company and decides to take it over. And so that's mergers and that's acquisitions. Then we've got the equity capital markets business. The bankers within the equity capital markets business are advising their clients on how to raise money using equity. So they go into the equity markets and find the best solutions for the companies that they are advising. So equity capital markets focuses on raising money using equity. When we say equity, we mean ownership of businesses. So you might give money to a company, in return you're going to get some stock. That stock is considered equity. Now, bankers in the equity capital markets division will advise you on how to raise money using equity in order to run your business more smoothly, or in order to achieve whatever goals you might have as a corporation. Okay, then you've got debt capital markets and leverage finance. These are very similar in that they focus on debt and how to raise money by issuing debt. So debt capital markets is similar to equity capital markets, where you're advising clients on raising capital, except equity capital markets focuses on issuing equity to raise capital, whereas debt capital markets focuses on issuing debt to raise capital. Now, the difference between debt capital markets and leverage finance is that debt capital markets focuses on good quality debt, so investment grade credit or investment grade debt, and leverage finance focuses on bad quality debt, so high yield leverage loans. Because the debt you're dealing with in leverage finance is more risky, your returns are likely to be higher. And so leverage finance and debt capital markets are very similar. You give loans, you lend money in order to raise money, and that money is used to improve your business, for example. And the bankers are advising you on the best way to go about doing that. And then you've got restructuring. The restructuring business focuses on advising corporations on how to kind of operate more efficiently in order to grow and generate more revenue. And they do this by looking at the organization's capital structure. They look at how the business is set up. They look at how it's run. They look at areas where they don't think are useful, or there's no longer a need for that business, or it could be tweaked or adjusted. And they basically restructure the business in order to make it more successful and efficient. Who are the clients of the investment banking division? Typically 3 main clients. You've got big companies, you've got governments, and you've got institutions. When we say institutions, they differ from companies because institutions are managing money for individuals or other companies, and they're investing it on their behalf. If you learned anything new in this video, make sure you give it a thumbs up. If you haven't subscribed already, make sure you subscribe to the channel. Make sure you turn on post notifications. And if you want me to do a video focusing on more detail within what I've mentioned today, so focusing on industry groups and product groups, which are very important within the investment banking division, leave a comment below and give this video a thumbs up, and I will see you in the next video. Peace.